more generally, as Otmar and Axel just said, this interaction has been important, remains important in our ongoing reflection on how to design monetary policy. So let me express my gratitude on behalf of the Governing Council, on behalf of the ECB staff, for your attention and your perceptive understanding in these last 8 years, but even before. Thank you. Now I'm coming to the formal part of my speech. The last year has seen a loss of growth momentum in the euro area, which has extended into 2019. This has been predominantly driven by pervasive uncertainty in the global economy that has spilled over into the external sector. So far, the domestic economy has remained relatively resilient, and the drivers of the current expansion remain in place. However, the risks to the outlook remain tilted to the downside. The monetary policy measures we took at the last Governing Council meeting reflect this assessment. In the face of a weaker growth outlook, they help maintain a commodity policy stance that we managed to preserve last year as we rotated our instruments from net asset purchases to forward guidance. Our policy thereby continues to accompany the recovery on its path towards our inflation objective. We expected the expansion to slow down in 2018 as the business cycle matured and growth retreated towards potential. But as the economy weakened in the second part of last year, it wasn't yet certain whether we were witnessing a temporary departure from this scenario or a more lasting deterioration in the growth outlook. The drivers of the deceleration back then appeared to some extent to be idiosyncratic and short-lived, relating to the effect of emission standards on the euro area car industry and a normalization of world trade from its very strong growth rates in 2017. Yet, it was clear that the loss of growth momentum could become more broad-based and persistent if two risks were to materialize. First, if external demand were to remain weak, and second, if this were to spill over into domestic demand. In the meantime, the first risk has by and large been realized. The weakness in world trade has continued, which has significantly affected the manufacturing sector. Global goods import growth in January reached its lowest level since the Great Recession, on the back of rising uncertainty about trade disputes and a slowdown in emerging market economies, especially China. As a result, growth in extra-euro area goods exports was negative at the end of last year for the first time since January 2016, and industrial production fell by 4.2% year-on-year in December, its largest decline since 2013, before recovering somewhat in January. Indicators such as new export orders, which have historically been closely associated with industrial production, remain in negative territory. So, we are now seeing a more persistent deterioration of external demand. But a soft patch doesn't necessarily foreshadow a serious slump. During the 4 euro area business cycle's expansion since 1970, there have been 50 soft patches, defined as a 2-quarter growth slowdown and only 4 recessions. In fact, the euro area faced an analogous situation in 2016 when the economy also went through a soft patch triggered by a contraction in world trade. At that time, the strength of the domestic economy was able to shield the recovery from external uncertainties. So, the key question is whether, with monetary policy continuing to support the expansion, domestic demand will remain as resilient today.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.